Oh, podcast number 3, Wall Street Breakdown. How did we get here? Soup Stain?
I have no idea. Hard work.
It was a lot of hard work.
It is a lot of hard work.
There's just a lot of financial news all the time. So
it never stops.
Yeah, it never stops.
Never stops.
It just makes it easy, right? Like,
yeah.
I just go out fishing for the news, put my opinion on it, and here we are again.
Well, yeah, this is podcast 3, huh?
And you're going to host this one.
I'm
for
definitely
sure.
Hosting it.
We're for sure saying this one is yours.
This one is mine.
This one is yours.
Oh, yeah.
Okay, so who are you?
I am Anthony from Wall Street Breakdown.
You're Anthony.
I'm Anthony.
I reference you sometimes in the videos now. Do you notice that?
You do. Once in a while.
Yeah, when you're editing them, you notice that?
Yeah, I did.
I'm like, oh,
the
Anthony,
last one you did a couple of
I think about you off screen.
Yeah,
like,
off screen, but it's not here right now.
You're not actually here.
He's off in the ether.
Yeah, you're somewhere else in life, but I think of you as, you're here with me. We do this thing together.
Spirit,
so
right?
Absolutely, right? You're my spirit animal. Absolutely.
Right on.
So, yeah, financial news was, there was a lot of earnings this week, but even though we had all these earnings come out, I was shocked with all the talk. There was so much other news out there that I think maybe didn't get the kind of coverage that it deserved. I think there was a couple things probably got the coverage it deserved. There was a lot of bigger news. I'm shocked with a week with as much earnings as there was that we're going to be covering probably equal amounts earnings to actual just individual news topics. That was my shock. I thought going into earnings this week it was going to be another week like last week where it was just going to be inundated with earnings.
Oh,
earnings. But
well, it wasn't this bad this week.
Anthony from Wall Street Breakdown, I'm going to let you take this.
All right, let's look at the news from Monday, October 30th. Sorry. Let's start with Bitcoin.
Oh, November 3rd. From the future. This is
future,
Monday from the future. I will tell you all about it. Bitcoin. So a couple of these stories, they just panned out through the week. So what we ended up having was a story that would kind of manifest itself on a Monday or Tuesday. And then we'd get little extra pieces to stories. So when we cover these, I guess I'll just give you the whole story. So this is the entire week of Bitcoin. So Bitcoin up above 6,400. I mean, Bitcoin was moving something fierce. It was moving fierce early this week. Up 500% year to date. So Bitcoin is doing phenomenal. I mean, it's, again, we've covered all what I think about it. I'm not going to get into the whole thing, but later in the week, we had the CME group, the Chicago Mercantile Exchange, add Bitcoin. They're going to add them to their futures exchange. So that's huge. That really legitimizes Bitcoin. And I was saying earlier in the week that I think the big problem with this is that we don't really know where Bitcoin's going or what the implementation is going to end up being. And again, I get into the same thing I've said before. But they then legitimize it by putting it on a major exchange like this, and now you have people that maybe were on the fence about if this was speculative before. Now they're going to actually probably think of this as a legitimate investment and not something that they should look at in their portfolio as speculative. It's speculative.
Right.
We have to reaffirm it's not oil. You're not purchasing a commodity on a futures exchange like that. This is something that there's no tangible proof that it's going to be something people are going to be able to use, and it's not going to be implemented on any kind of wide scale at any point. We don't see that. There's no future that anybody can pinpoint of where Bitcoin is going. It's a great concept if you like the concept, and I personally don't even think the concept is that great when you just think about how well the monetary system runs already in a lot of countries, because it's strong. People want to give the monetary system a lot of gaff, but I don't think it actually deserves it. I think a lot of times the people controlling the monetary system are doing a fairly good job of controlling inflation and stuff like that. So Coinbase, which is the major exchange for cryptocurrencies, added 100,000 subs.
That's huge.
In a matter of a day, because the CME went ahead and said we're going to hold Bitcoin on these future exchanges, and it gave legitimacy again to it. So while Coinbase is up significantly in subs this year, I think they started the year at 10 million and they're at 12 million now. They got a big bump off of this. So I mean, Bitcoin is out there already in the mainstream media. This is just going to further put it out there. The CME was the first to jump all over it as one of the major exchanges to get into it. But, I mean, for me, it's just not... It's still... We talk about it because it's great news, and it's really interesting to talk about, and I love to see how it unfolds. And if it turns into something, there's going to be a lot of people that are... that were on the front line that already have made probably ridiculous money, that are going to continue to make great money. But, I mean... It's still speculative. As far as I'm concerned, it's a good thing to look at, just to watch, but it's not. It's more media than it is actual investing.
Oh, for sure.
Yeah, absolutely.
Well, how about that SoftBank deal that's going on? I believe it was a deal.
Yeah. So this is going to be a whole week, a wrap up. So we heard early in the week that SoftBank, which is the majority owner of Sprint, was potentially thinking about pulling out of their deal with Deutsche Telekom, who's the majority owner of T-Mobile, because we got this Sprint T-Mobile merger that was on the table for a long time, and so people were saying, oh, it could be pulled out the very next day. So we were hearing that like it was going to end, and I believe on CNBC, David Faber said that he'd heard that it was probably not going to be that day, but that they were looking into it, like looking into not really doing this any further. But I think everybody thought that this was going to go down. Like when they tried to do this a few years ago, right? These guys tried to merge a few years ago. The FCC put the kibosh on it. They said it just wasn't as competitive of a landscape. The FCC gave them the green light like right off the bat this time. So it looked like this was going to go down because like Sprint or SoftBank, they have a lot of like network issues that they're going to have to invest a lot of money in, and it's going to cripple their share price, the amount of money that they're going to have to put out to upgrade a lot of this stuff. If they would have gone on with T-Mobile has a lot of this infrastructure already built, and they would have been able to meld these two things together, which would have saved Sprint the cost that it's going to cost now and the time to actually go out and implement all this stuff. Right. So I don't think anybody thought that they was going to come off the table. I think everybody thought that this deal was going to go through and there wasn't going to be any issues, and that we were going to see like a major number 3 player in the telecom industry in the United States after AT&T and Verizon. And so we heard that, okay, so they might pull it off. David Faber over at CNBC said like, maybe not now, but later. And I think a lot of people thought they were really playing chicken with each other because they were having some issues trying to figure out like the governance, who was going to run this company, who was going to be in charge of what divisions, and what the actual value was going to be. Because while Sprint needed T-Mobile, or I think they still need T-Mobile, Sprint is worth a ridiculous amount of money in comparison to T-Mobile, right? So, but it ended like it's straight up. They pulled it off. Like they said, no dice. They're not going to do this. Like both CEOs have put out a report saying like they're just not, or interviews saying they're just not. They can't come to an agreement. Like, which is strange. Like for them to not be able to table the agreement, because it just seemed like this was like a match made in heaven to really compete.
Seemed like it.
Yeah, like, and we were talking about this for weeks, and this gets a lot of play. Like people really seem to enjoy the Sprint T-Mobile, the drama of it, right? And I understand, because I mean, when you consider how tethered you are to things like your cell phone, you're going to be involved in one of these companies, AT&T, Sprint, Verizon, or T-Mobile, if you're in the United States.
Well, they're huge, right?
And you're carrying that thing in your pocket all the time. So you definitely do associate with your provider, just like you associate probably with the manufacturer of your phone as well, as an Apple user, a Samsung user, whatever, right? So I think that's why it gets a lot of, I think people are really interested in it, because it really does affect a lot of people's cell phone plans usage.
For sure, yeah, definitely.
But it's not happening now, so there you go. After weeks and weeks, this didn't blow up like AT&T and Time Warner. That's been taking forever to get done. This year they started it and it crashed and burned in a month.
Yeah, that was fast actually. Let's look at Constellation Brands.
Yeah, so that's up here in Canada. Constellation Brands is a big American liquor company. And they have like Corona and stuff. They have a big roster of liquor. They came up and they bought 9.9% of Canopy, which is basically a grow-op for legalized marijuana that's in Canada, or like, I guess, medicinal marijuana, whatever you want to call it. So again, very speculative. $245 million was the price that they paid. I think they value Canopy's market cap at like $2.2 billion. But like, I have a big problem with this whole thing. Like, I'm not going to get into it morally or whatever, but like, just with the licenses, and like, I just see this as the first step of a company coming up here and trying to like get into it. But we're going to have companies that have so much capital that they can just come up and buy up licenses, and I don't think companies like Canopy that are so over leveraged already just to get started are really going to be the front runners. Even though they're the front runners right now, the industry really hasn't gotten its foothold, or we haven't decided. Just because the legalization hasn't happened yet, there really isn't that like fixed path of where things are actually gonna go. We just like have good assumptions of where things are gonna go.
Yeah.
And I don't think those assumptions are really all gonna play out the way people think, because we've had this on the table before. I've been hearing about. We're from Canada. We've been hearing about the legalization of stuff for decades, bro.
Yeah.
So like, sure, it's gonna happen next summer, and if it does, and whatever, like, then the implementation of how that's gonna happen, I think, is gonna be very paced, and they're going to make adjustments at every step. So for people to assume that like this is going to be it, it's very speculative. Again, this is something like I understand how interesting it is to watch. It's a new sector, like entirely. It's a new sector all of a sudden being traded, and it's growing. Obviously, there's a lot of money being invested into it. There's a lot of media being invested into it, but to like say, hey, go out and spend your money on it, that's not my advice. That's for sure. So yeah, Constellation Brands. I mean, they see the money in it. They know they're not taking it to the States yet, but you might as well get in early, because I would imagine big money's coming as soon as Canada finds exactly what they're going to be doing with the legalization of marijuana, whatever you want to call it.
Yeah. Okay, that wraps up the news for Monday, October 30th. Let's look at Tuesday, the 31st. We got some earnings calls. Let's start with Sony.
Yeah, there was some great earnings calls on Tuesday. I guess we'll just pick out the best ones. Sony earnings per share 90 cents, beat the street by 36 cents. Revenues at $18.25 billion, beat the street by $690 million. That's up 9.2% year over year. This is their best fiscal profit year ever. Their game and network services are up 35.4%. Their home entertainment stuff's up like 20-some%. I mean, they're making moves. Sony is unbelievable, kind of coming out of nowhere. They closed the week at 44.81 with a price to earnings at 24.30. So it's still a really high price to earnings. Like, it's tough to say like Sony would be an investment I would get into. Now they've jumped pretty good since the earnings call on Tuesday, like the price per share. It's a great company. They're really turning it around, like, and they're doing it on the back, obviously, the PlayStation, which is doing a marvelous. Like, we looked at some of the numbers earlier this week, and some of the numbers I think said that like the PlayStation stuff that's going on right now is beating the PlayStation 1 stuff that they set like all the benchmarks with. And they're beating it by like 20% in every category. Like, they're just putting a whipping on it. Like, it's not...
That's huge.
Yeah, they're huge numbers, right? So Sony is definitely... And they're doing it on the back of that. Like, and when you think of Sony, they've always done it on the back of like their electronics. They're doing it on the back of their video gaming. It's big stuff. Sony's doing really well. Like I said, price per share is a little high for that price to earnings, but it was a great earnings call. And I mean, you love to see a company like Sony that really kind of tapered off as far as like major electronics manufacturer. Like, they were on the precipice of everything before. They were the forefront through the 80s, the 90s.
Oh, for sure.
And
definitely.
Sony eventually they kind of fell to Apple and all those companies.
Microsoft,
there's so many more fancy companies. So to see Sony still really trudging away and like really smashing their own benchmarks,
right,
in an industry that like this ain't the Walkman, right? They're not selling the Walkman or the Discman anymore.
Not anymore. I heard they actually wanted to bring back the
really,
Walkman,
that's some retro stuff. Yeah. But I mean, like, they've been doing the PlayStation a long time, but they get better and better at it.
For 22 years now.
Yeah,
they've been doing it.
To get better and better at something that's that cutting edge that you need to. Like, it's how do you stay on the forefront of a technology that's being developed like in front of you for 22 years?
No.
That doesn't make a lot of sense, right? Like, it's something that's right there. You see it as like tangible, but because there's like 500 directions you could go in, and every other company could choose a direction to go in, you don't know what's going to be the right one. So when you're making more right calls than wrong calls on a technology that's like building itself as you're basically building it,
right,
you're building it, Sony, right, or Apple, or any of those companies, right? So like, to do that is amazing. 22 years, and to have the PlayStation do better now than it did in its major years, right?
Okay, let's move on to U.S. Steel's earnings.
Yeah, another great earnings call. I think it's really shocked people. It was just based on really good, solid, fundamental company running, to be honest with you. So U.S. Steel earnings per share 92 cents, beat the street by 22 cents. Revenues of $3.25 billion, beat the street by $190 million. That's up 20.8% year over year. But this quarter was like, it was so strong for them because like their investment gains, a lot of stuff they've got their money into is doing really well, and just operating efficiencies. They were doing so well. Just they didn't have any issues. Like, it's one of those things where you can plan how much steel you're going to make, basically, and how much steel you're going to sell. That's why they're a major dividend company, and they're not a growth company where you never look at it like that. But when you get quarters where just like plants, nothing goes wrong, everything works to your advantage, and you all of a sudden produce more than like what your predicted loss time is going to be, right? Like, so you're predicting that you're going to be at what efficiency, right? 88% efficiency or something, and you blow it out of the water and become 93% efficient. You have quarters like this where all of a sudden you're looking at numbers where it's astounding for a company that should be really, really predictable. So they were able to take $200 million in net debt off the books. So it brings them like $1.2 billion, I believe, which is not too bad. $27.04 they ended the week at. Price to earnings is still 40.36, so it's really high price to earnings. It's U.S. Steel. It's a company that doesn't do a whole lot of stuff. It doesn't move around a whole lot. It's up, I believe, this week $3 maybe after this earnings call. But it was a really good quarter. It shows really good management. I mean, it's a strong company that pays their dividend all the time. So I mean, it's really tough to have anything negative to say about it. It's not something I would necessarily say like get invested in, but heck of a good quarter. It was very impressive on Tuesday when I thought this was going to be one of the worst of the earnings calls.
All right, let's look at one more earnings calls for Tuesday. Cummins. How'd they do?
Yeah. Oh, again, we only cover the good ones on the wrap up, buddy. That's the only way we're doing it. EPS at $2.71 beat the street by 24 cents. Revenues of $5.3 billion beat the street by $510 million. That's up 26.5% year over year. The engine department revenue up 24%. Distribution up 17%. Components up 34%. They closed the week at $173.07. The price to earnings of $17.57. That is a price to earnings worth looking into for a company that's this strong. It's a really big price to pay. But, I mean, when you take a look at what, like, you think about the truck and SUV sales going on in the United States right now and how strong that is with the economy. You think about the builders, and you know where Cummins has all their stuff, right? Like, their engines are in big vehicles. Big vehicles doing some big work, right? You see builders are doing really well. We've seen earnings from builders now. We're not up to Lennar or Pulte Group or any of those guys yet, or KB Home, but we've had Pulte Group. We've had Pulte Group, right? But we don't have some of the other big builders yet. But we've seen Caterpillar. We know that there's a lot of construction. Everything is still going really, really strong at all ends in the United States as far as the economy goes. That puts a company like Cummins where your engine's in a lot of higher end vehicles and in a lot of work vehicles. That puts you in a really good position. Price to earnings of $17.57 trailing, and a set of divisions inside the company that are going up in double-digit percentages year over year. It's not something I would say not to look at. It's definitely something I would sit down and look further into if you're not into something that's similar to it. If you're not in a sector entirely, if you don't know maybe the auto parts sector or just auto manufacturers, and Cummins and all that stuff probably comes in a basket like that as well. But if you're individually picking, Cummins not too bad of a way to touch into the auto sector.
No.
Yeah, not a bad company to take a look at.
Okay, let's move on to Wednesday, November 1st, which I thought was an interesting story here, the Disney one.
Yeah, so like Disney's doing their own streaming service. So we know they're getting off Netflix. A lot of these contracts are ending. They're kind of making demands as far as like the theaters go. I guess they know the theaters, Cinemark and Regal and stuff, just aren't doing as well. Like Cinemark actually had a really good earnings call this week, but I guess they understand they're not doing as well as they could be doing. And they've got them over a bit of a barrel. Why not take advantage of them? I mean, that's just good business. I mean, are you really burning that many bridges when you consider that, I mean, these guys might not even be around. Yeah, right? They might not be around 5 years from now, and if you find a way to do these streaming services, you might not even need them. So why not ask for 65% for The Last Jedi for the admissions? Why not ask for 70%? Why not just back them into a corner? Like, I understand that like the shareholders over at Regal and Cinemark and stuff probably don't like to hear that, but I mean when you've got the strong hand, like you play it.
Yeah.
So I don't see anything wrong with it. I think Disney should do what they've got to do. Disney holds the cards. Disney has the movie that people want to see. The theaters are the ones that are struggling. They need this holiday season movie way worse than Disney needs them.
Oh, for sure.
They're going to pay. Like, they're going to pay. You know what I mean? And Disney's still going to probably leave in a couple years and put all their original content on a streaming service for $10 a month. And they're going to kill it with the stuff that they do.
Yeah.
Because Disney kills it. So, yeah, I don't know. I take what I want when I can take it too. So good for Disney. I'd ask for 70%. I would have made them negotiate me back down to the 65 I wanted. Why not? Like,
why not?
Why not? It's The Last Jedi. It's gonna push so many units that Yeah, Regal and Cinemark are gonna have to pay.
Let's look at another story about the Bank of England.
Yeah, they raised their benchmark overnight rate, the interest rate, 0.25 per basis points up to 0.5, or 250 basis points up to like 2.5% to 0.5%. And it's the first raise they've had since the financial crisis. They cut it. It was at 0.5 for a long time. And they cut it with Brexit. So like a year and a little bit ago, they cut it back down to 0.25. But they rode at 0.5 through the financial crisis from like 2007 or 2008, whatever it was. So it was at this rate for a long time. So it has not found a way up. So like I cannot imagine that the Bank of England, which is, I mean, England's doing really well themselves. It's probably going to go up again, probably 2018. I think we're going to probably see this get a couple of jumps too. I mean, we've seen Canada get a couple of jumps now. Again, they've pulled back. Like they didn't jump this last time, like 2 weeks ago. But like we're probably going to get another one at least early 2018. And I could see the Bank of England, like the Brexit thing seems to be working out. They seem to be finding their footing a little better from, I think, what a lot of people were really shocked by when it happened. And I mean, it's time. It's really time for countries of this size that are getting their economic footing behind them again to put a little bit of onus back on the taxpayer. That's just kind of how the thing has to work, right? Like to get the monetary system working. Like people hate to hear that, but like money has to flow through everywhere.
Well, it has to. Yeah.
Like it has to, like it has to go in a big circle. Like because if it doesn't, then we get all these bottlenecks and the money doesn't work properly. So like anytime when interest rates are down, it's good because it allows a lot of other people to start to sock things away. It allows companies to be able to borrow at a much cheaper rate. But the fact of the matter is once that engine starts moving a little bit, you got to pay the piper.
You have to.
I mean, and we all have to pay back into our economy to make sure our economy stays strong.
So let's move on to another story. I'm not too sure about this company myself, but let's take a look at Funko.
So yeah, these guys, I mean, I know quite a bit about toys. You know quite a bit about toys, Em.
Sure
What are you talking about? So yeah, they did an IPO. They did make these Funko, these vinyl pop figures. I mean, they do them for like every franchise. They're like
Everything's been done in Funko.
Oh yeah, the licenses. I mean, the license money they must pay must be ridiculous to begin with. And they don't do anything. There's no articulation. I don't. People collect them. They take up like wall space. It's a bunch of like boxes that like stack really well.
Yeah, that's
they look interesting, I guess, when you first see them, but like when you now look, like every record store, toy store, everywhere sells a bunch of them, and there's millions of different ones, so you're never like gonna collect them all. Like I don't know, I don't see the draw in them. Like I think Funko realized what they were doing early and realized that it like worked.
Yeah.
And they were just like, you know what, like, let's just pump it out. Like, let's get every license we can get from everything and just hammer the marketplace. And why not?
Why not, yeah.
And now when, I would imagine the hype is starting to die, because we see them everywhere.
Everywhere.
The hype is starting to die. We see them on sale. We see them on sale today at the mall, right?
Sure, yeah.
Like, West End, they were on sale, right? So, like 3 for like $16 or something. Like that, yeah. So like, what next would you do? Well, you take your company public, because they don't have anything else in their roster. Like, you go on their webpage and like everything else they have is not anything else I've ever seen anybody buy. Like, it's no offense, right? I'm sure people buy their stuff. I mean, they're a company that exists. But I don't know of anybody that's actively looking for their stuff. And I know of a lot of people that deal in toys.
Yeah, and nobody ever comes to us and asks for Funko.
No, I've never heard. Yeah, back in the day, we owned a toy store.
We did,
yeah. We owned a toy store for a long time. And we never, back in the day, ever had. We had the vinyls, the Funko Pop vinyls, the stuff we're talking about. But back then, they were hot.
They were really hot,
They were Beanie Babies or Starting Lineup or anything else that was Spawn. Anything else that was huge for a little period of time, right? But they're never going to be Gen 1 Transformers or anything.
Never,
they're never going to be the stuff that's worth a lot of money.
No.
So they IPO'd. I think it was $12. They opened the day at 8. It was a slaughter. I mean, it was a slaughter. They closed the week at 7. It's brutal. I mean,
that is brutal, yeah.
Yeah, it's brutal. It doesn't, it's not a company that I would understand why anybody would actually invest in. Like, did they get like a bunch of fanboys?
Maybe
we got a couple thumbs down for our video. I noticed that.
Yeah, I noticed that too. Yeah,
people had a lot of Funko Pops.
And they must be fans or something.
And they bought stock.
Yeah.
That's not the way to do it. That's not the way you buy stock. You don't buy stock with your heart. You buy with your mind.
Exactly. That's
right. You never buy or sell stock with your heart.
No.
Never. So the Funko was a brutal IPO, and it looks like it's just gonna get worse.
All right, let's take a look at an earnings call. Tesla.
Yeah, a lot of bad news recently at Tesla. Like, not bad news at Tesla, but there's been like layoffs, and there's been a lot of like news from like the Wall Street Journal and stuff, like questioning Tesla's integrity with their guidance and stuff that they've been giving. So earnings per share of a negative $2.92, missed by 62 cents. So they were expecting a pretty good negative. They missed by even more. Revenues at $2.9 billion. That's up but $40 million, like that beat the street. That's up 29%, 29.6% year over year. And they trade at $306.09. I mean, it's ridiculously expensive. They delivered 26,137 vehicles in this quarter, and they say in 2018 in the first quarter they're going to start getting about 5,000 Model 3s off the line every week. But we've heard them make so many promises with so many different things that they're doing that like it's great, but like
Let's see something.
your credibility with your guidance just got called into question by the Wall Street Journal like not long ago. So when you give forward guidance for what you're doing from this point on until you really start proving your point, like quarter after quarter, I'm kind of on a wait and see approach because at $306, I'm not touching it. It doesn't matter. Like it's ridiculously expensive, like so overpriced. Like they're gonna have to like take over the auto industry like entirely just to justify that price point. Like. And that's not happening, not anytime soon. So, yeah, I'm on a wait and see approach. I wouldn't buy Tesla at $306. Not with a gun to my head, but it's a decent forecast. I mean, I'm always optimistic of what Tesla's gonna do because they do get not only are they well reviewed vehicles, but they definitely are cutting edge as well. So, if the industry ever takes off to the level that I think a lot of the Tesla fans or a lot of the people that believe in it. And Tesla themselves think it's going to, Tesla could be crazy. But right now, $306 with, like, I mean, that revenue growth is fine, but that EPS is in the tank.
Yeah.
It always worries me. Amazon and stuff used to be like this, you know, like Netflix. These companies always...
Now they're huge.
They just worry me when you see this kind of stuff because you have to, like, be absolutely positive that that's going to be the one that works. Otherwise, you're going to eat it. You're going to get soaked in this, right? So...
Okay, we have one last earnings call for Wednesday. I would say the largest, if not one of the largest social media sites.
Oh,
Facebook.
yeah, largest. There's an IPO you wish you would have been in on, right? Facebook, when that one IPO was at $25. Facebook closed the week $178.92. That's $34.67 price to earnings. It's cheap.
Yeah.
Facebook is cheap still, as far as I'm concerned. EPS of $1.59 beat the street by 31 cents. Revenues at $10.33 billion beat the street by $490 million. That's a 47.4% revenue year over year. Facebook knows how to make money. Like their net income's up 79%. Mobile ad revenue went from 84% to 88% because they know everybody uses their phone. When that badge comes up that you've got somebody on a Facebook thing that mentioned you or liked something of yours, they know you're going to click that. Facebook is a monster. Like I can't remember what that IPO was. And I remember it pulled back. I'm pretty sure like in the first couple of days off that IPO that it like pulled back to like 18 or something. There was like something. Man, that IPO, son. Like I wasn't sure back then because when you looked at it from a perspective of whenever that thing went public, 2008 or whatever it was.
Yeah, around there.
Yeah, it was something like that, right? You look at it and you totally saw like MySpace.
For sure.
No, it wasn't 2008. It would have been like 2012, 13. It wasn't 2008. 2012, 13, something like that, right? You saw MySpace so much. Like you were just like, the thing was here and then it was gone in like a matter of no time. Like Rupert Murdoch and like the guys over at Fox bought MySpace, like when MySpace was huge, and MySpace like it was gone in an instant. And everybody was using that apparently. Like that's what we were told. So like when this went public, it was such a big deal because nobody knew how Facebook was going to monetize.
No, not at all.
They couldn't figure out how they were going to do this ad stuff, right? Like, because it was still relatively new. Like, you got to, it was a whole new thing to have this social network that also was able to drum up money at the same time and not be like intrusive. The social networks always were like the MySpaces where they weren't real. They were like belligerently intrusive with the way they looked, but they weren't inundated with advertising. Facebook's done such a good job of streamlining the advertising, where the advertising is like out of the way. Yeah, it's beautiful.
Or it just seems like a post.
Oh my god, it's beautiful. Facebook does an amazing job. It's an amazing company. Like that's another one, like the Cummins one. I would say, like if you're looking into companies, Facebook's not ever a bad thing. Like $178, I understand it's very expensive, but. Yeah, it would have been nice to get into right off the bat. But it was so easy to compare it to what had failed before. But they've done so many other things to just reaffirm their their standing in the marketplace, why they're important. Like their user base goes up all the time, and their user base is already in the billions.
Oh, I know.
And it goes up all the time. So that just goes to show you, like, they're doing something right. They're doing everything almost right. Almost everything right.
Let's move on to Thursday the 2nd. We got earnings call from Alibaba.
Yeah, another company doing a lot of everything right. Like here's another example of like a growth company that could one day justify the price, right? So like EPS of $1.29 beat the street by 26 cents. Revenues at $8.29 billion beat the street by $440 million. That's up 60.7%. 60.7% revenue growth year over year. They closed the week at 183.21. Price to earnings of 61.66. That's very high, but it's a growth company, so that's not stupid high for a growth company, but it is high. It's high enough that it makes you trepidatious.
Right.
But when you look at what they can do and who they're hooked up with and the marketplaces that they work within, they have a lot more leeway with what they can get away with.
For sure.
They are... Yeah, so core commerce up 63%, cloud computing up 99%, digital media and entertainment up 33%.
Wow.
They work in so many different avenues, and everything's going well for them. Like Jack Ma, Alibaba, this company is a bulldozer, and the idea that they're not going to be a major player probably forever till the internet's not a real thing anymore, because of the wholesale, the way they do the wholesale structure over there is amazing. Alibaba's such a great company. They're on par with Amazon, just not at the revenue number yet, but I mean it's going to get there quite quickly, I would imagine. Alibaba, heck of an earnings call. It's really a matter of if you find it comfortable to be at 183.21. That's really the thing. Is the share price. Other than that, it's not a matter of the company. Like you would be hard pressed to find any advisor out there, I think, that would tell you you're looking at a bad company. You're looking at a strong company that is going places. But does that number concern you? Because numbers do sometimes tend to correct themselves as companies go from growth to a lot more long-term strength. But I don't think Alibaba's anywhere near the end of their growth phase. So 61.66 price to earnings might be totally fair.
All right, let's move on to one more earnings call for Thursday. Apple.
So here's a company that I think, because they've got dividends now and all this kind of stuff, they still got so much cash. People look at this as not a growth company. I'm not sure why. Like, I don't know why Apple all of a sudden is not like they don't do a billion things. You know, they do 4 or 5 things really well. They do the Mac stuff, they do the iPad, they do the iPhone, they do the watch, they do this home thing now, this Apple home thing. They don't do a million things. They're not in 50 different rackets. They're in the good rackets that they're good at. But people don't look at them as a growth company. You take a look at it, earnings per share at $2.07, beat the street by 20 cents. And again, this is a company that's looked at by everybody and their dog.
Everybody.
So when you're beating the estimates by that much, I mean, you're doing in-house. You're doing strong work. Revenue of $52.6 billion. $52.6 billion. I just said they don't do a lot of rackets.
No.
They're not out there selling like furnaces and fixing elevators, and they're not doing that. They're just
selling a couple products.
They sell like a handful of things. Like you can fit their products on your kitchen table.
For sure, definitely.
Revenue of $52.6 billion, beat the street by $1.81 billion. And again, they don't look at this as a growth company. Revenues in a year where the phone numbers should be down because people knew a new phone was coming out. Revenue up 12.3% year over year in the quarter. Revenues in the Americas up 14%, Europe 20%, China up 12%, and that's the huge one because the idea that they're going to beat Samsung right now, where Samsung kind of owns the OLED market and Apple needs them, and Samsung obviously is going to keep stuff for themselves as opposed to giving it to Apple first. Samsung has a bit of leverage, but as we get into Apple and LG being teamed up and Samsung being put off to their own, and Apple having their own chance to have their own manufacturer, make their own stuff on their own deadlines, I see Apple really making a push again. But to beat Samsung is going to be tough. But Huawei out of China is the number 2 smartphone maker, and to make this kind of growth in China, 12% is big. That's big growth.
That is big, yeah.
I think iPhone sales were only up like 3% year over year, but iPad sales up 11%, Mac sales up 10%. Price to earnings 1960. That is low.
Yeah,
that is bloody low for a company like this. Like, I know everybody thinks this is just strong blue chip company that pays good dividends. They have so much cash. This iPhone X is doing so well. Like, people love it. They love Apple. If you're an Apple fan, you are all in. Like, they have probably the strongest loyalist following of any kind of digital anything, whether it be a video game console, anything. Apple is probably the ones with the most loyal fan base. Like that,
You're probably 100% right on
if
that.
you're Apple, you're Apple.
You're Apple,
you know, like, yeah, 1960 price to earnings to me seems such a cheap number. When you consider what Apple still has on the table, they're a growth stock still to me. Still to me, they are.
Okay, that wraps up Thursday the 2nd. Let's take a look at Friday the 3rd. We got a kind of a story that hits kind of home here. Canada's jobs.
Yeah, we got some jobs. I didn't get a job, and you didn't get a job.
No.
We're still hobos. Like, we're shooting this podcast under a bridge, but like we're gonna get a job.
We're gonna get a job.
I swear.
Swear.
That's on Monday.
Monday.
The diet starts Monday.
Always starts tomorrow, right?
The diet and the job search are both tomorrow. Canada's job numbers were great. I think they were estimating like 15,000 in growth, and we got like 35,500.
That's pretty decent.
Yeah, it's a pretty good beat, right?
Yeah.
The unemployment rate went up a tick, though. I think 6.3 from 6.2. But Canada's just doing better overall. So, like, every time we see these numbers, it just reaffirms that we're making progress. It's incremental progress. That's how these turnarounds always are. But we just were in what would be considered, through a lot of the provinces, if you use them as a collective, somewhat of a strong downturn. Like, sure, some provinces were doing really well throughout all of it, but it was a strong downturn as a collective throughout Canada. And I think now we're really actually starting to see a lot of the provinces find some prosperity, which is a good sign, because I mean, here in Alberta, we've taken a drubbing with our provincial political party and stuff. It's been a bloodbath as far as where our money's all gone.
Let's take a look at the CVS story. I thought this was pretty interesting.
Yeah, CVS is buying Aetna apparently. I don't think people thought it was really going to happen, but apparently it really is going to happen. So CVS is buying Aetna $66 billion. That's a pretty big So where this story comes from originally is Amazon has a bunch of pharmacy licenses, like wholesale pharmacy licenses that they went out and purchased. And I think a lot of the retail pharmacy companies are really concerned with Amazon getting into the pharmacy business, because Amazon already has all the infrastructure set up to ship things, and to take orders, and to do all that stuff, right? So you have companies like CVS that I think...
In panic mode a little bit.
A little bit, right? Like, so you go out and like, you get bigger by picking up a company like Aetna that's in like medical devices and all that stuff. You really branch out now.
You definitely do.
So you step away from having to worry about just this one thing. I mean, it's a big, daunting sort of a task for CVS to do this, because you're going to be integrating a company doing different things than you do. Yeah. But it's a little different. It's in the same field, but it's a little different, right? But yeah, I don't think people thought this was going to be real, but $66 billion, it's a really high like price for what Aetna is. Like, Aetna never even got to that price by the end of the week, I don't think, for what the value that CVS was giving them. But it could be a real coup, because it could really hedge out what CVS has to worry about potentially Amazon getting into the pharmacy business, and really putting a crunch on CVS's margins, I imagine, is what the big concern is, right? So this helps them move into another direction. And, you know, like, it's always interesting to see these kind of things, because you watch these, what are already large companies, get together, and you wonder, like, is it going to be a match made in heaven where these companies become so dominant, or is it going to be where you pulled in way too many directions and it's too bloody hard to keep up with 50 different segments, you know, and you have all these good segments that are running well, but bad segments are constantly dragging them back down, right? So we'll see. CVS buying Aetna $66 billion.
Let's take a look at this Broadcom deal.
Here's another one, right? So like two semi-chip conductor makers. So they both make stuff. They go inside phones and the iPods, everything you're using right now for your technology, computer, any of that kind of stuff. So Broadcom wants to buy Qualcomm. So they've offered. This is an unsolicited bid. So this is stock and cash. $103 billion is what the valuation is. That's about $70 a share for Qualcomm. So it's a big increase. I think it's 25% over what Qualcomm actually was trading at the time. But I guess Broadcom really wants. There's been a lot of there's been a lot of these companies in the semiconductor sector that have conglomerated, that have got together and become bigger companies. Then this just kind of continues the trend of it. But I'm not sure if this would get past. Like, these are huge companies. These two are
Huge.
monsters. Yeah, like this would be big. This would be big, big, big. And I wonder how much this would actually like play into, like the monopolization almost. Like I'm not entirely sure, right? Like what the regulators would look at this as, but this is a big move. Like they're paying a real premium for Qualcomm if this deal goes through. I'm sure the guys over at Qualcomm are thinking it through, because why not? I mean, it's a heck of a premium. Why not?
Oh, it's definitely something to think over.
Sell
right?
your shares,
Yeah.
right? If they want to pay you 25%, like where do you see Qualcomm going? Like, I know they're in every device already. They do all that, but like if you're already in every device, what does that mean? Like, are they going to make more devices? Are they going to make more people? Or do you have more potential to like have a pull back?
Right.
And have somebody make something better than you, right? Like, it's all about the contracts you sign, and it's one bad arrangement or one bad chip or something could end up being where your company pulls back super significantly. So like Qualcomm is probably at the top of their valuation of what I see for their like near term future right now, and then to add 25% value on top of that from Broadcom seems like a deal that, I mean, I don't know if the guys at Qualcomm would see a problem with it. I don't know. As a shareholder of Qualcomm, I wouldn't see a problem as it. So
No,
I would do it, yeah.
Well, I guess that wraps up the news for this week.
That's it.
That's it. We're
That's
done.
it. We talked, and that's it. That's it. I told you, like, the earnings, there was some earnings, and there were some really good earnings, but there's a lot of stories going on. Like, there's just a lot of really good talk. I love when financial news is busy. All these mergers and acquisitions and stuff really spice up
A lot of intrigue.
Yeah, love the intrigue,
Love
right?
the intrigue.
I don't see how you could live your life without all this stuff. People who don't dig this, I don't understand. And we talked about this before. Like,
Well, this makes the world go round. All this
so
money,
many,
right?
yeah, all this money in these companies are intertwined with everybody in their day-to-day lives. They don't even realize it. And
No,
so
not
many
at all.
hundreds of billions of dollars at play all the time.
Yep.
To not be riveted by this, to me, is baffling. I'm just I love being a fly on the wall and being
For
able
sure,
to kind
yeah.
of just see this go down all the
Yeah.
time and just have my own little opinion,
Yeah.
have a little introspective, and you kind of like play your foresight and think like, could I see kind of how this plays out? But you never can, right? You go back to this SoftBank, Deutsche Telekom, Sprint, T-Mobile thing. I didn't see that playing out that way.
No, me
I
either.
totally saw that being a finisher where like those
Yeah.
two were going to get together. That was going to be the deal, and like, ta-da,
Ta-da,
like
there
that
you
was
go,
it,
yeah.
right? Like, and it didn't play out that way. So like, for me, it's, I don't know, it's riveting. I'm a nerd. I like Wall Street, bro. I'm Cody from Wall Street Breakdown. This was podcast number 3. You were
Anthony from Wall Street Breakdown.
and we did an excellent job. This was a long Sunday. We hope you guys really enjoyed this podcast. We love doing this stuff for you. These recaps are great. I think it really consolidates the whole week. We hope that you guys enjoy all this. We want to hear from you. Comments, like the video, subscribe, do the whole thing. Have yourselves an excellent rest of your Sunday. It's Monday tomorrow, and it's time to get back to real financial work.